ओके सर, अभी स्टार्ट हुआ।
Shall we start, sir?
Yeah, please.
Good evening, friends, and welcome to this very interesting meeting to learn the amendments by the Finance Act 2023, as well as very recent developments in the field of reassessment procedure, Section 148, from our learned speaker, C.A. Nikhil Tiwari, and with the able chairmanship of Sri MP Lohia, sir. I have a privilege of welcoming you all and introducing our distinguished chairman and the speaker for the evening. First, I would like to introduce our chairman, Mr. MP Lohia. He is an advisor with tax practice and an international taxation and transfer pricing expert. He has worked in the income tax department in various capacities, including the Commissioner of Income Tax Appeals and the Director International Taxation. He has also worked as the Under Secretary in the Tax Policy and Litigation Wing and Foreign Tax Division of the CBDT, Ministry of Finance. He was also a part of the high-powered Committee on E-Commerce Taxation, the Working Group on the Study of Non-Resident Taxation under the Kelkar Committee, and the Committee for Rewriting of the Direct Tax Code. Accounting Standard Committee constituted by CBDT for notifying accounting standards under the Income Tax Act and also transition to IFRS regime amongst others. He is from the 1982 batch of the IRS, where he was awarded the Finance Minister's Gold Medal and the Kamath Govindan Nair Gold Medal. Sir has a very distinguished career, and I know him for many years, very humble and ready to share his knowledge with all of us professionals. So please welcome Mr. MP Lohia. Sir, we welcome you. I have a privilege of introducing C.A. Nikhil Tiwari, who is a director in tax and regulatory services at SRBC and Associates LLP, member of the EY Global, based in Mumbai. He is a rank holder chartered accountant from 2007 batch and has more than 16 years of experience in handling direct tax appeal matters before various appellate forums and litigation advisory in the field of corporate tax, international tax, and transfer pricing for several multinationals and domestic clients in a wide range of industries. He has been actively involved and is a regular speaker at internal as well as external forums, including ICI, WRC, BCAS, Chamber of Tax Consultants, etc., on technical and non-technical topics. He has co-authored various articles and publications on international tax and transfer pricing. Please welcome C.A. Nikhil Tiwari. We welcome you, sir. And with this, may I hand over the proceedings to the chairman of this session, Shri MP Lohia. Thank you, sir.
Thank you very much, Mayur Bhai. Good evening, ladies and gentlemen. It is my great pleasure to be chairing today's session on international tax amendments under Finance Act 2023 and reassessment of cases before assessment year 2016-17. The Finance Act 2023 has made a handful of amendments in the domain of international taxation, which will be discussed in today's session. Certain amendments such as that made to sections 44BB and 44BBB have been introduced to settle the debatable proposition as to whether brought forward losses and unabsorbed depreciation can be utilized against the presumptive income. While there have been favorable decisions in this regard, including the one which I remembered I argued before myself before the tribunal, it appears to be against the legislature's intent, and that is why perhaps an amendment has been made in this section. Similarly, further, the legislature has now also brought residents but not ordinarily residents into the scope of section 918, which was earlier not applicable to them. Accordingly, now gratuitous receipts of monies by resident but not ordinary residents from residents shall be covered under the deeming fiction of section 9 and chargeable to tax. Similarly, the scope of angel tax under section 56(2)(7)(b) has also been expanded to cover receipt of monies from a non-resident by a resident closely held company for issue of its shares in excess of the face value. By doing so, the legislature seems to have opened a Pandora's box of possible controversies. In addition to the amendments pertaining to international taxation, today's session shall also cover controversies surrounding reassessments, particularly involving cases prior to assessment year 16-17. Finance Act 2023 marks the third consecutive year in which the reassessment provisions have been amended. Together with the judicial developments from 2021 onwards, the controversies make for an interesting study. Particularly, the controversy today involves the interplay between the proviso to section 149(1) as it stands today with the extension of time limit provided by TOLA, that is Taxation and Other Laws, Relaxation and Amendment of Certain Provisions Act 2020. While conflicting views have been adopted by different high courts on the issue, the Honorable Supreme Court seems to have adopted the view favorable to the revenue. So though today's topic is for controversies for assessment years prior to assessment year 16-17, it is imperative to also study controversies pertaining to assessment year 16-17 as well as 17-18, which seems from the aforementioned interplay. So with that being said, I now invite CA, my colleague Nikhil Tiwari, to start the session and will be benefited by his presentation. Sri Nikhil Tiwari.
Thank you, Loyaji. Thank you, Mayur Bhai, for such a nice introduction. I hope I am audible.
Yes, yes.
Yes, you are audible very much.
So, without wasting any time, I will straight away start my presentation. And before starting my presentation, I will share the screen wherein my presentation will be visible. Okay. So I have divided my entire presentation into two parts as topic suggests. The initial part will be dealing with the international tax amendments in Finance Act 2023, and thereafter in later parts we will discuss the recent reassessment controversies mainly prior to AY 16-17 and also after AY 16-17. What is the position which is being adopted by courts and tribunals? The first amendment which I am going to discuss today is amendment made to section 918. What is the amendment to section 918? The present section 918 was added by Finance Number 2 Act 2019, wherein they have deemed certain things to accrue or arise in India, which otherwise was not accruing or arising in India. What was that thing which was deemed? A sum of money which was gifted by a resident to a non-resident was deemed to be accrue or arise in India by way of this amendment, which was done by Finance number 2 Act 2019. Now, in this Finance Act 2023, they have added one more category of person, that is resident but not ordinary resident, who is receiving a gift from a resident will be deemed to accrue or arise in India. Now, naturally, they will be covered by the exceptions which is there in section 56 to 10. That is, if gift is received from the relatives or if it is falling in any of the exception criteria, it will not be chargeable to tax. Again, the next controversy which will arise here is whether section 195 will be applicable here. If you are resident but not ordinary resident is receiving a gift from a resident, whether a resident is liable to deduct tax under section 195. Here the answer would be no, because for the purpose of section 195, a resident but not ordinary resident will be treated as resident only. And section 230, which fictionally treats resident but not ordinary resident as a non-resident, this is only for limited purpose of section 92, 93 and 168. So that cannot be extended to 195. Now, while I was going through this amendment, I was not able to understand why this amendment came. And I was also not able to understand that after this 2019 amendment, which came and wherein the non-resident was introduced in this section 918, what was the subsequent fallout of this? In 2021, as everyone is aware, there is amendment in section 6, wherein they have added one more category of stateless person in 6(1)(a), and also they have added one more category if a person who is of Indian origin is receiving something, is having a source of income from India which is exceeding 15 lakh rupees, then there will be some differential treatment as far as his residential status is concerned. I will slightly come to this point, which is there in my second slide, and what is the interplay of that with this section I will briefly discuss. Before that, one more important point here to understand is that now for taxing any income, the first and foremost thing is that that income has to be defined in the definition of income. That is section 2. Now the 56 to 10 is already defined in the definition of income. Now the second thing is that income which is going to be charged, there has to be some charging section to tax that income. Now that charging section was already there in section 56 to 10 from 2017, and prior to that it was in the form of 56 to 7. Now the third limb, which was a basis of charge, it was missing here, and that is the reason why in 2019 and now in 2023 they have amended this section. If all the three things are not satisfied together, you will not be able to tax this amount as income. Now someone will ask, why only sum of money? Why not all other category which is there in 56 to 10 is added in 918? Answer to this is that all other things which is there in section 56 to 10 will have a source in India itself. There is no need to extend that by way of a deeming fiction in section 9 to say that they will be deemed to accrue or rise in India. But this transaction wherein a resident is giving a sum of money as a gift to a non-resident, who, let's assume, who is receiving this gift in USA, there will be a doubt, or someone can argue that this source is not there in India, and therefore the basis of charge has to be there. Now, if we read this amendment, the next question someone will ask me, okay, this came in 2019, non-resident, and now resident but not ordinary resident from 2023. But this section is there from earlier years. What will be the position in the earlier year? Is this amendment in a way suggesting that in the earlier year, this amount was not chargeable to tax, or in the earlier year, it was chargeable to tax, but this is something which is a abundant precaution amendment, and meaning and explanation of this has to be treated in a deemed retrospective manner. Now, this question, in fact, I have in all those all the other amendments which I am going to discuss, and this creates a doubt. Someone may say that the government has given some kind of assurance that there will not be any retrospective amendment going forward. And if that is the case, and even the memorandum explaining this amendment is not explaining that this is something amended to clarify the things which was there in doubt earlier, one can take an argument to say that this is not a clarificatory amendment. And prior to this, if this is the situation, this amount will not be chargeable to tax, taking the clue from this amendment itself. Now, I have given one example here, which is there in my next slide. And why I have given this example? Because I was not able to get answer to this question. See, in my example, it is a very simple fact. There is a Mr. A who is a person of Indian origin who is residing in US. In the financial year 23-24, which is a financial year started just now, but for the argument purpose, I have given this financial year because amendment is from this financial year. He visited India for 125 days, and his total stay in India during the preceding 4 financial year was totaling to 370 days. During the financial year 23-24, his India source income was 14,50,000 rupees. Now, in addition to that, in this financial year, he is receiving a gift of 1 lakh rupees from his friend, which is going to be given to him in the USA. Now, the two questions which arise here: what is the residential status of Mr. A under Section 6? Second, what is the implication of Section 918 here? Now, I was not able to get the answer to this question, and somehow the answer to this question is going to answer why this amendment was made. Though this is not explained in the memorandum explaining, but I suppose this was the intention. Now, if we see Section 6(1), which defines the person who can be a resident in India, in 2021, there was an amendment. If a person is in India for 60 days and in the last 4 years he was there in India for more than 365 days, he will be a resident in India. But there is an explanation. In explanation, it says if a person who is of Indian origin, he comes to in India, then this 60 days will be treated as 182 days. Now, 2021 has amended this to say that if a person who is of Indian origin, he comes to in India, and if he has an income source from India, which is exceeding 15 lakh rupees, then instead of 182 days, it will be 120 days. Meaning thereby, if you are in India for current financial year for more than 120 days, and in the previous 4 years you were there for more than 365 days, you will be treated as resident. Then there is a Section 6 subclause C, which says that then in such a situation, you will be treated as resident but not ordinary resident. Now, in given facts of the case, first I have to ascertain before computing the charge on income, what is the residential status of Mr. A. If I go to this section, because I have earned an income from source in India is only 14,15,000, wherein there is no dispute, because 14,15,000 will be otherwise chargeable to tax irrespective of my residential status, as unlike in rupees 1 lakh rupees, which is linked with my residential status. If I am non-resident or resident but not ordinary resident, then only it will be chargeable to tax. So I have a source of India, income from India is 14,50,000 rupees. I will be treated as non-resident, because in the current year, for 60 days, it is word substituted is 182 days, and more than 365 days, I have to satisfy both the condition to be there as a resident. I am not going to satisfy a condition of 182 days, then I will be treated as non-resident. Now, once you are treated as a non-resident, then Section 918, which is there from Finance number 2 Act 2019, it says then this 1 lakh rupees is chargeable to tax. It is deemed to appropriate in India. If you include this 1 lakh rupees into your income, then your income from source in India will exceed 15 lakh rupees. If it exceeds 15 lakh rupees, the clause 6(1) explanation 1B says, if your income source from India exceeding 15 lakh rupees and you are there in India for more than 125 days, you will be a resident. But you will go to 6(6) clause 6, you will be resident but not ordinary resident. So because of this particular situation, one thing was dependent on another. There could have been situation in facts of this case before the amendment to say that this 1 lakh rupees is not chargeable to tax, and I will be a non-resident in this situation. So therefore, to cover this situation into section ambit of tax, and also to clarify what will be the residential status, they have amended 918 to say that in such a situation, this 1 lakh rupees even if you are a resident but not ordinary resident, will be included in your income and it will be chargeable to tax. This was the only reason which I could think of, was the basis reason why this was the amendment. But now again the question is this definition of residential status is amended from 2021. 918 started from 2019. Now this amendment is in 2023. What will be the position in 19 till 21? What will be the position till 21 till 23? And what will be the position 23 onwards? I have discussed the position what will be 23 onwards, but I'm not sure what will be position prior to that and how one have to look to the entire situation. And with this, I will move to my next slide, which is the next amendment. In between, I'm looking at my notes, so just don't think that I'm not looking through my presentation, because I have written some of the notes here, so it is relevant to state that understanding on what basis I have prepared this presentation. So now the next amendment is 44BB, 44BBB. Now both sections are pari materia in terms of how they have been written, but the scope of sections are different. 44BB is for if non-resident is engaged in the business of providing services, facilities in connection with prospecting, extraction, production of mineral oils, and 44BBB is for foreign companies engaged in the business of civil construction erection in connection with trunking power projects. In both the situation, it will be deemed that your income is 10% of your total amount. And then how to compute that has been defined in section 44BB and 44BBB. Now, prior to this amendment by Finance Act 2023, earlier there was a controversy how to compute the income. See, this 44BB and 44BBB is a notwithstanding section. It says notwithstanding anything contained in 28 to 43 or 43A, your income has to be computed in this fashion. Now, you don't have any other option but to compute your income in this fashion. Now, in a situation where an assessee was having a loss, which was in a year in which you have opted that you will not govern by 44BB or 44BBB, whether you will be able to take the benefit of those losses when in the year in which you decided that no, I will have to be governed by 44BB. That was the dispute in all the earlier years. And the first decision which came from the tribunal was for AY 1978-79 in the case of Tino Kasha Limited. Now, this is a reported decision. The issue there was twofold. First issue was because this section is overriding section 28 to 43A, whether unabsorbed depreciation, which is a part of section 32, which is coming between 28 to 43A, whether you can claim that unabsorbed depreciation from the year in which you have prepared a books of accounts to this year wherein you are offering your income under 44BB and set it off against your 44BB deemed income. This was the first issue. The second issue was the unabsorbed business losses, which comes from section 72, will be available against this deemed income. The Honorable Tribunal in this case has categorically decided both the issues in favor of the assessee. 72 was slightly easier issue for tribunal to adjudicate because this deeming fiction is only overriding 28 to 43A. So 72 was naturally out of it. So this says you will get the benefit of 72. The second issue was slightly trickier issue, whether you will be able to take a depreciation, unabsorbed depreciation benefit. The Council of the Assessee has smartly argued there that see, the unabsorbed depreciation is nothing but a loss which is in the nature of business loss, but because legislature has artificially given an extra benefit to unabsorbed depreciation, that what is the extra benefit? Two extra benefit. Unabsorbed depreciation is carried forward for a number of years, and unabsorbed depreciation will be treated as a depreciation of the next year. If it is unabsorbed in the first year, it will be treated as a depreciation of the next year. This is a business loss with these two extra benefits. If I decide to not take these two extra benefits, it will remain a character of business loss. And therefore, before the tribunal, assessee argued that I am not going to take these two benefits, that is a number of years carry forward, and the benefit of it will be treated as next year's depreciation in terms of hierarchy of getting benefit of depreciation. Then it will retain the character of business loss, which was its original character, and therefore you should give me the benefit of this loss set off as well, to which the Honorable Tribunal has agreed and they have given this benefit. Now, it is interesting to know that this tribunal decision was passed by two bench of member, and both the member have given a different order. Both the orders were in support of the SSC. The first member has given his reasoning to allow the claim. Second member agrees to that reasoning and he has given his own reasoning to allow the claim. Nevertheless, that is not going to make any difference. It is an order of tribunal which was in the favor of the SSC. Then again, a similar issue came in the case of Anchor Line. This was for AY 8384. Why I am mentioning AY here is because in these AYs, the depreciation was allowed to be carried forward for a number of years, because everyone is aware here that in between period in 90s, another depreciation was again restricted for 8 number of years from 96 onwards. Again in 2002, it was given n number of years carry forward. So someone might be able to say that I am someone say that this can be distinguished because this might be of that period, but that is not the fact here. It is of that it is of the period wherein the depreciation was again could have been carried forward for a number of years. Now in Anchor Line again, the Honorable Tribunal has considered the TINO decision and they have allowed. Here department has relied on some other decision of courts wherein they have denied this kind of situation, but because the TINO decision was of the Mumbai Tribunal, in Anchor Line, the Honorable Mumbai Tribunal has preferred to follow the earlier Mumbai Tribunal decision. Now, this was the position as far as these tribunal decisions are concerned. Now, the matter again came in 2015 in case of a Boscalis Mumbai Tribunal, wherein there was the issue of unreserved depreciation and business loss. As far as business loss is concerned, it was a simpler issue for the tribunal. Tribunal decided the issue in the favor of the SSC. As far as the issue of unreserved depreciation is concerned, the tribunal decided to not follow these two decisions of the earlier Mumbai Tribunal, and they said that it will be governed by 28 to 43A, and it is deemed to be allowed your unobserved depreciation, and you will not get a fresh unobserved depreciation here. After this tribunal, there was again various other tribunal decisions, but more or less after 2015 in Mumbai, the view is that you will get the unobserved depreciation, but you will not get you will get the business loss, but you will not get the unobserved depreciation. Now, this was the earlier issue which was slightly debatable. Both kind of rulings were there as far as unobserved depreciation is concerned, but there was ruling or entire ruling was in favor of the SSC as far as business loss was concerned. Now, what is the amendment in 2023 Act? 2023 Act says that your unobserved depreciation as well as business loss will not be allowed if you governed by 44BB. Now here it is interesting to note that this amendment is prospective amendment from 2023. Again, I have the same question, whether by making this amendment, are you trying to say that for all earlier years, even unobserved depreciation could have been allowed to be set off against your 44BB income, which was as such debatable, there were for and against tribunal decision, or you are trying to just clarify something which will be treated as a retrospective effect? That is the thing which is the same question which I had for the first issue which I was discussing, which will still be there in this case as well. Now, here there are various other issues which could come. Now, the one issue is, now if you see 44BB subclause 3, subclause 3 says, notwithstanding anything contained in subsection 1, an SSC may claim lower profits and gains than profit and gains specified in this subsection if he maintains books of accounts. Now 44BB subclause 3 gives an option to the SSC to claim a lower profit by maintaining a books of accounts. So naturally, in the year of losses, SSC maintains a books of accounts to claim a lower profit. Now, in the facts of the case, if SSC has done that and there is a loss which is available for carry forward. Now, in the current year, if I prepare a books of accounts, there is a profit of more than 10%. Whether I will be having an option to prepare a books of account in that case, or option is only if I have a profit lower than 10%, then only I will be excluded by the subsection 3. If we go by the literal meaning of subsection 3, answer to this is yes, you will be out of 44BB only and only if your profit is lower than 10%. If it is more than 10%, you cannot say that I don't want to follow 44BB, because the language of section A has been in such a fashion. Now, then issue arise. Let's assume in 1 year, I have a gross receipt of 10,000, which is my last bullet point, and net income of 1,200 rupees. So 1,200 rupees is more than 10%. Now I have a brought forward losses of past year of 5,000 rupees. Can I opt out of 44BB here? That is the question. Now this can be divided, to my mind, this can be divided into two parts. Now, what is this 5,000 consist of? If this 5,000 consists of, let's assume 300 rupees another depreciation and 4,700 rupees business loss, I will take an argument that while computing my profits and gains from business profession, depreciation comes under section 32. And if depreciation comes under section 32, my net result of profit and gains from business profession is 900 rupees, which is lower than 10% of as specified in 44BB clause 3. Therefore, I can opt out of 44BB. Once I opt out of 44BB, all other loss for 4,700, which is a business loss, I will be able to set off. If my entire loss is a business loss, then I think that will be a slightly debatable point to say that no, I can opt out of 44B. Now, whatever I have stated while giving reference of section 44BB, that will be equally applicable for 44BBB. With this, I will move to the next amendment. Now, this amendment is in section 56(2)(7)(b). As you are aware, if any resident who used to purchase the shares of a closely held company, wherein the price of share exceed the face value and the consideration paid is over and above the market value or fair value of the shares, then the extra amount was chargeable to tax in the hands of the domestic company under section 56(2)(7)(b) of the Act. This section came quite a few years back, but this was specifically stated that this will be applicable to an investor who is a resident in India. Now, this year, this has been amended to include a non-resident also within the definition of the person who is going to invest in the shares. Now, the position will remain that if a non-resident is investing in the shares of a closely held company and the condition of this section is getting satisfied, that is, it is exceeding the face value of shares, your consideration, and the consideration is over and above the fair value, then it is chargeable to tax in the hands of company. Now, you are all aware, this controversy is not new, that at the same point of time, there is section 56(2)(10), which says if any person is obtaining any benefit, it will be chargeable to tax if that benefit is exceed 50,000 rupees. So in a given set of fact, if a non-resident, if he is purchasing the shares for less than fair market value, and that difference is exceeding 50,000 rupees, it might be chargeable to tax in the hands of non-resident as a gift. So to come out of the 56(2)(7)(b) and 56(2)(10), you have to purchase the shares at a fair value, that is a market value. If it is lesser than market value, the shareholder will caught under 56(2)(10). If it is more than market value, the company will caught under 56(2)(7)(b). There is some exemption given for startups if it is registered by Department of Promotion of Industry and Internal Trade. There is condition given there if it is satisfied. What could be the shares? These all controversies are old controversy, which was there when the resident investor was investing in the shares. Now it will be equally applicable for the non-resident, that it will include convertible shares and all those things, but it will not include the convertible debenture. Now, earlier there was a tribunal decision which has held that this this section was specifically for residents, so non-resident is out of the scope of this section. Now this is no longer applicable in view of this specific amendment by Finance Act 2023. These two tribunal decisions I have quoted in my PPT, which is at third last bullet. Now, again, this second last bullet is slightly a different controversy, irrespective of whether you are purchasing at fair value. If you are not able to explain the source of source, then there can be a trigger of section 68, which will be independent of 56(2)(7)(b) and 56(2)(10). The last point says that if some taxation is happening in this section, there is no corresponding cost step up for the investor. For the investor, the cost will remain same. So there is a double taxation which is inherent, which is there in this section, which was earlier applicable to resident. Now it will be applicable to non-resident. Now again, this controversy is old controversy whether if there is a valuation mechanism under the FEMA which says normally that if it is at minimum amount should be minimum fair market value. If there are difference in the value as per the FEMA or Companies Act and the value which has been determined by the valuer as for the fair market value for this section, what will be the fate of this? Which value has to be taken? And whether two wings of department or two wings of the government can have a two different kind of valuation and which one prevail over other. Now this second bullet point here, it states that now everyone is aware that earlier when there was a decision in the case of Vodafone Bombay High Court, wherein the issue was if a non-resident is investing in the shares of Indian company, this incidence is not giving rise to any taxability, and this is a capital account transaction and transfer pricing provisions will not be applicable. The Bombay High Court has allowed this issue was decided in favor of the SEC, and ultimately it was the decision of Bombay High Court was accepted by the government, and there was no further appeal to the Supreme Court. And basis this Bombay High Court decision, in fact, when they have introduced their TP reference mechanism by way of instruction number 3 to 2016, they have incorporated the findings of Bombay High Court to protect the taxpayer, wherein they have a capital account transaction between the AEs, whether it can be referred for the TP computation. Now, the point here is that if it is a closely held company and your non-resident investor and your closely held company is a related person or associated enterprise, then this argument that ultimately there is no income element here and it is not chargeable to tax will not be applicable, and it can be stated that your income is chargeable because you are not satisfying the condition of 5627B. Therefore, your TP provision and everything will come into picture, and it will be applicable for resident. And naturally, if it is applicable for non-resident, and naturally, if it is applicable for the non-resident investor, then it will be applicable even to a company as a mirror transfer pricing report. Now, the two more controversy which can come here is what if the share application money is received prior to 31st of March 2023, but shares are allotted post April 2023. So, to my mind, if shares are allotted post 1st April 2023 to a non-resident, then this section will come into picture. Now, the second controversy is though the shares allotted prior to March 2023, but amounts or installment paid post 1st April 2023. Now, here the trigger event is the investment in shares. Again, this investment was prior to 1st April 23. So, in second last bullet point, it should not be chargeable to tax under section 5627B because your event is prior to amendment by Finance Act 2023. With this, I will move to a next slide. Now, this slide discusses the amendment made by this act in the rate of taxation for royalty and FTS. Now, as everyone was aware, the rate of tax was 10% plus applicable surcharge and cess. It is now increased to 20%, which is equivalent to what is the rate of tax given for the dividend. As you are aware, the history, if you see the Congress government in 2013, they have increased this royalty rate, which was earlier 10% to 25% by Finance Act 2023. While doing that, the reasoning and logic given was that in most of the DTA, the rate is 20-25%. So to give an equal or playing field, we have to increase the rate of tax even under the Act to 25%, and therefore they have done that. Immediately after 2 years, when the government was changed, the new government came into picture in 2015. They have changed it to again 10%. While changing it to 10%, the reason given here was that now there are various startups which is getting promoted. The government intends to promote various startups. For a promotion of the startups, there has to be import of technology. If you want to import a technology, there is to some kind of concession given on rate of taxation on those technologies so that this will be cheaper and it will be available to those young generation people who is going to invest in the startup. And therefore, to encourage or promote this, they have reduced the tax rate from 25% to 10%. Now the same government in the second term, now they have again increased from this 10 to 20%. Now this amendment they have made straight away in the Finance Act. This was not there in the bill. So therefore, unlike earlier two amendment where there was a reason and logic explained why they are doing so, what is it, what was it in their mind while doing this? This is not available here because this was straight away done in the Finance Act. Nevertheless, even though we don't have the reason available, but we are aware that these kind of amendments are made by this government in last 2 to 3 years, wherein some kind of tricky issues which they feel that is will have a problem or wherein they will receive most of the representation, they make it by way of a Finance Act directly rather than putting it in the bill. Now, if you see some of the DTA, wherein the earlier assessee used to take a benefit that the tax rate under the act was more beneficial as compared to DTA rate, wherein the DTA rate was 15 or 20% in US, Canada, Belgium, Italy, or Denmark. Now they will be able to take a benefit of those treaty because now tax rate under the act is higher. Now in the last 4 slides, I have mentioned that if under the act you have option, if you can file a return of income, if you have only income by way of a royalty and FTS, and if you pay taxes as per the act is already deducted, then you need not require to file a return of income. Now the option here is that if you don't file a return of income, you will not be able to take a DTA benefit if DTA rate is lower. So what could be the situation, whether you should file return of income here or whether you don't file return of income here by taking appropriate credit of that taxes in your source country or host country, if that credit is available in that country. I have mentioned that, but again, that controversy is not very important here. But the point is that this is going to hurt the industry and this will have the larger impact than the way it has been introduced. With this, I am moving to the next slide or my next amendment. Now, this amendment is amendment in section 197, wherein the 194 LBA section was not specifically mentioned there to obtain a lower or nil rate benefit. Now, 194 LBA is wherein a business trust is distributing its income to its unit holders. What is the rate of tax? So they have given a logic that some kind of business trust, which is a sovereign wealth fund and pension fund, they are exempt under section 1023. And if they are exempt in section 1023, they might not be required to deduct TDS. But because this section specifies the rate and they are not specifically covered in 197, so therefore there was a compulsory TDS. To avoid this kind of situation, they have introduced 194 LBA in 197. So this kind of business trust now can go to the officer and obtain a lower or nil rate of withholding certificate. With this, I am moving to my next amendment, which is amendment to section 196A. Now, this is very important here to understand the mindset of the government. As you are aware, some few years back, we had a decision of the Supreme Court in a case of a Qualcomm. This decision of Supreme Court was dealing with section 194E. While dealing with section 194E, I am not going on to the merits of this case. What was the issue? This association was formed by various countries, cricket bodies, and there was a Cricket World Cup of 1996. All those things, and what was it? How TDS has to be deducted for sports association which has participated in this event. That was the issue. But one para of the Supreme Court, wherein they have in para 18, wherein they have mentioned that whether the benefit of DTA will be applicable while deducting TDS under section 194E, to which the Supreme Court has said that no, it will not be applicable. This has created a problem. And there was various issues surrounding to this, how to interpret the Supreme Court decision, whether the Supreme Court decision is sacrosanct vis-a-vis all the TDS sections, or this have some other limitation or connotation. Now, the government's understanding of this Supreme Court decision I will explain today, which somehow we can come from this, understand from this 196A amendment. But before going into this 196A amendment, I would slightly discuss the amendment made by Finance Act 2021 in section 196D. The 196D is for income of foreign institution investors from securities, and 196A is income in respect of units of non-resident. Now, while in 2021, when they were amending section 196D, what they have amended, they have inserted one proviso to say that this section will also get a benefit of DTA rate while deducting TDS. So the understanding of government was the section 196D, which specifies a flat rate of 20%. It does not discuss any other thing like rate in force or something like that. So therefore, while deducting TDS, the payer will not be able to take a benefit of DTA rate, and therefore they have amendment section 196D in 2021. While putting this amendment, they have specifically clarified this point in the memorandum explaining the Finance Act 2021. What they have clarified? They have clarified the intent of Supreme Court decision to say that the Supreme Court decision will be applicable here, because here the flat rate of 20% is specified, and because of that, in a genuine cases, the DTA benefit will not be applicable. To give the DTA benefit, they have added the proviso. Now that is the situation. Now, in 2023, this similar provision of 196A or similarly placed provision of section 196A, again they have added a similar provision here, which was there, which they have added in 2021 in 196D. But in this year, they have not explained the same rational logic which they have explained while amending 196D. Nevertheless, I don't think so it make any difference, though they have not mentioned the similar logic in while giving the memorandum explaining the bill, but things remain the same. Now the issue is, under what circumstances you will be able to take a benefit of DTA rate at the time of deduction of TDS. Now, if you see section 195, which is the main section, which is for all other transaction with non-resident where his income is chargeable to tax in India, you have to deduct TDS and 195. Now 195 uses the word rate in force. Now there are two other sections, section 194B and 194BB, wherein they uses the word rate in force. There are three other sections, 194 LBA, LBB, LBC, wherein they use the word rate in force. Now this rate in force is defined in 237A. If you go in 237A, it says rate in force means rate specified in the Finance Act and the DTA rate. Now, while saying the DTA rate, they says for DTA rate, you can only see three sections. Sections 194 LBA, 194 LBC, LBB, and 195. So only for these four sections, rate in force will include even a DTA rate. So while deducting TDS for these four sections, income arising as mentioned in these four sections, you can take into account the DTA rate. Other than these four sections, now there are two sections wherein there is a specific amendment, that is 196A, which is there in 2023 Act, and 196B, which was done in Finance Act 2021, wherein they specifically inserted the proviso. Now, by virtue of that proviso, you can take a benefit of DTA. Other than that, all other sections, you will not be able to take a benefit of DTA if income is arising to any non-resident. The rate which is mentioned therein has to be deducted while deducting the TDS. While filing the return of income, that non-resident can take benefit of DTA, but not at the time of this. I am not commenting anything on the correctness of this proposition, but I am commenting here that this is the thing which is there in department's mind, and department is looking the Supreme Court decision in this fashion. And now, therefore, wherever they want to give the benefit of DTA rate, that section they are slowly and gradually amending, and all other section where they don't want to give a DTA rate, that section they have not amended. Now, again, the controversy will be why this amendment from one particular year, this section was there from the earlier year. So from 1 year onwards, only you want to give benefit, or this is clarificatory. This is again a same query which I had while explaining the issue of First Amendment, which can be argued and debated in the courts. With this, I think I will move to the. I think this is all as far as the amendment in the Finance Act 2023, which was relevant for international tax, and which I could foresee, and which I have included here. With this, I think I will now move to my next topic, or the second topic here, which is given to me, reassessment of cases. Before that, Loyaji, if you have any comments or if you want to say something here, then please come in, or else I will move to the next amendment, next topic, sir.
No, Nikhil, I think you have covered in a very lucid manner all the important amendments brought by Finance Act 23. And in the interest of time, I think you should go ahead with your next topic.
Okay, sure. Thank you, sir. Now, the next topic is slightly trickier topic, and the considering the time limit given to me to discuss this topic is short. So therefore, we have carved out the topic into cases wherein the reopening has been made prior to section 17, so that we can finish it within the time allotted. But before I start straight away to what is the controversy for the cases prior to section 17, it is important to understand in brief what is the new 147, why there are so many controversies here, and what was the reason for which this new 147 was came into picture, and whether this is serving its purpose. If we understand this in brief, then only we will be able to understand the controversy surrounding the earlier years, where reopening can be done, cannot be done, beyond 6 years, 10 years, 3 years, everything we will be able to understand. With this background, I will straight away come to this new reassessment proceedings, which was inserted by Finance Act 2021. Now, the earlier 147 provision mainly was based on reason to believe. Now, the entire theme, essence of the section was basis reason to believe. The new and the, if you see the controversy under the old provision in all the tribunal, High Court, Supreme Court decision, even though SSC might have various other arguments to quash the reassessment proceedings, SSC always take the argument that there was no tangible material, which was a fallout of reason to believe, and this is change of opinion, which was again coming from the reason to believe. Now, therefore, when they have substituted the new 147 provision, they have done away with the word reason to believe. Now, whether by removing the word reason to believe and inserting new section wherein the word reason to believe is not there, whether they have done away with the old controversy or not, that is something which we will see when these things get settled by various courts. But I will slightly discuss one or two High Court decision wherein they have discussed with this context, when it will come in my presentation. Now again, when this new 147 provision was introduced, the finance minister's speech, the memorandum explaining the bill was, it was presented in such a fashion that this is something, a benevolent provision which is given, and this is given for the benefit of the SSC, and we have reduced the time limit to 3 years, and in certain cases only it is 10 years. So it was presented in such a fashion that this provision is for the benefit of the SSC. In fact, the Honorable Supreme Court in Ashish Agrawal's case, while deciding the issue, has also understood this, and they have, in fact, detailed discussion. They have stated that this is a benevolent provision which was given for the benefit of the SSC, and therefore, in fact, they have said that this provision, which is substituted by Finance Act 2021, will be applicable from 1st April 21, because there was a controversy for 1st April 21 till 30th of June. Which one will prevail, whether old provision or new provision? The Supreme Court says the new is benevolent, beneficial provision to the SSC. It should start from 1st April 20. Now, if we try to understand the timelines, see, from there are I don't know, first of all, why the Parliament every year come up and change the time limit to pass the assessment. It is so confusing. I'm leaving that point aside for some other day. But as you're aware, for every assessment, you have to go and see the act and certain notification to understand what is the time limit to complete the assessment. Nevertheless, from AY 22-23 onwards, they want to complete the assessment within 12 months. Now, within 12 months, 1 year from the end of assessment year, your assessment will be completed. Within 3 months from the assessment, you will get a show cause 143(2) notice. Within 9 months, entire proceeding will be completed. At the one hand, they want to complete everything within 1 year, but at the same point of time, they are aware that within 1 year, if you complete something, you are bound to miss many things. And therefore, they have come up with the reassessment, which can be done within 3 years. Now, reassessment which can be done within 3 years is all cases except wherein it can go to the for 3 to 10 years. 3 to 10 years, they've said that if it is in the your income scaping assessment is in the form of asset, or you have found some documents, you found some books of accounts, you found some evidence, and your income scaping assessment is in the form of asset or some transaction or some event, and then in that cases it can go up to 50 lakh and it is exceeding 50 lakhs and can go to 4 years till 10 years. Now these are the two categories. To my mind, now this first category of reopening is nothing but extended assessment proceedings. Why I am saying so, I will come and discuss even one case also, wherein this issue was slightly discussed by the Honorable High Court, not Bombay High Court. But at the same point of time, they have said that the whatever documents you have received or you have examined at the time of original assessment proceedings, if this on the basis of same documents you want to do a reopening, then time limit will be 3 years. This is that observation of the Honorable High Court. I am getting convinced that the reopening within 3 years is nothing but a second assessment, wherein you did not have any new documents. On the basis of same documents, you can do the reopening, even though it satisfies the concept of information. This can be done. Now, the second category will be reopening, which is actual reopening, which will start from 3 onwards till 10 years. So now you have assessment into 3 parts. One will be summary assessment under 143(1), one will be 143(3) assessment, and then will be another 143(3) assessment in the form of reopening, which will be part B of the assessment. With this background, I will see this, though these slides are not meant to be discussed here, but it is important to understand the difference. Then only we will be able to understand the controversy, what is happening for prior years, that is earlier years, whether they are time barred or not. I am going to share this presentation with the participants, but I will not discuss all the points here. Briefly, I will touch upon, but slightly I will discuss all the cases which has been decided on each of the issues. So now under the old and new, if you see the difference, under the old, there was a term reason to believe. Under new, now the term is information which suggests that income scape assessment. Now this is the crucial point. In fact, 2 high courts have discussed this point when they have discussed what do you mean by information, and they say that even under the old, when the concept was of reason to believe, or even under the new, when the concept is information which suggests that income scape assessment, the primary condition which is on department to prove that basis the documents which you have, there is some kind of income which has scape assessment. You cannot say that just because you have information, you will straight away go for reopening. Information is stage 1. The stage 2 has to be crossed, that is, this information should suggest that income has scape assessment. Now, if you see 147 old, there were various other provisos which was inserted over a period of time. This is either to negate or to approve some kind of judicial ruling. Now, these all have been done away with when it comes to the new regime. That if your case is already pending before the judiciary, an appeal or revision, then you cannot do the reopening. Now, that is not there. Now, there are 2 ways in which we can interpret the new regime. One is we compare with all the existing section, earlier section, and say that look, it was not there in, it was there in earlier 147. Now it is not there in new 147. That means the intention of Parliament is to include this kind of thing as far as new 147 is concerned. Now the highlighted underlined portion here is second proviso, wherein if your same issue on a different facet is pending before the court or tribunal, on the same issue on some other facets you want to do a reopening, there is some kind of bar. Now that bar is not there. Department might try to interpret that now in new regime that bar is removed and therefore I can do it. Answer to my mind is that that is not the correct way to interpret, because the new regime has entirely shifted from the old regime. Now you have to satisfy the condition under the new regime. First of all, and basic condition is that you should have the information. Now, unless and otherwise you cross that bridge of information, you will not be able to proceed further. You cannot just say that because that proviso was there in the old, it is deleted now, irrespective of whether I have information or not, I can go ahead and do the reopening, even though the similar issue was pending before the tribunal. Answer is no. On the merits of this section, you have to satisfy, you have information. Then second, that information is should suggest that income as cases. Now, someone was asking me whether the controversy which was there pertaining to Jet Airways is still there or they have done away with it. Jet Airways was a case wherein the Honorable Bombay High Court was dealing with a situation when in the reasons for reopening in the old regime, there is only one issue on which the reopening has been initiated. And if you want to add any other issue other than the issue which was there in the reasons of a reopening, can be done or not. The Bombay High Court has held that if the reason for reopening is on issue 1, and if ultimately in the assessment that issue 1 is sustained, then you can go ahead with any other issue during the course of reassessment. But if the reasons for reopening is issue 1, and on that issue 1 itself you are not making any addition, then you cannot add any other point, even though you have income which has escape assessment during the reassessment proceedings, you cannot make that addition. Now, this proposition is still hold goods in new regime. But to my mind, there is a slightly higher protection given to the SSC basis the judicial presidency. Why I am saying so? Higher protection. Now, in the new regime, they have done away with the earlier concept of, done away in the sense they have incorporated that concept of GK and drive shaft, wherein the objection against the reasons for reopening was to be filed by the SSC, and that objection was to be disposed before proceeding with the reopening. Now that procedure they have incorporated by way of inserting section 148A. Now 148A has a 4 limb, A, B, C, D. A says a prior inquiry before the reassessment. If you have any information, basis that information, you can go to the SSC and you can inquire anything basis that information if you want to inquire. B says you have to provide an opportunity of being heard to the SSC of minimum 7 days time to be given, which can be extended till 30 days, wherein SSC can reply on the information which you have furnished to him. C says whatever reply SSC is filing, that has to be considered by the officer. And D says you have to pass an order disposing the objection under 144A small d, and then only you can proceed with the reopening. Now, the matter came up before the court, and the issue before the court was the 148A small a was on the issue 1. There was only one issue, issue 1. I have given my reply on issue 1. They were satisfied on the issue 1. While passing the 148A-D order, they said that no, I want to make addition under issue 2. SSC filed a writ. High Court has quashed the proceedings. This is your information is on the issue 1, basis which you want to do reopening. He replied, you satisfied. Now you want to do in issue 2. Not possible. Now, at this stage, at objection stage itself, you have to have, you in the sense department have to have that kind of order to say that they are going to make addition on the issue on the basis of which the information was provided. If that is not done at the 148A-D stage itself, they cannot proceed. This is the added layer of protection as far as the new regime is concerned. Now, if you move further, let's assume they dispose the objection on the issue 1. They says, okay, I'm making addition on issue 1. And during the course of assessment proceedings, they got to know issue 2, 3, 4. But in the assessment proceedings, ultimately they drop issue 1 and they only want to make issue 2, 3, 4. Again, this Jet Airways will come into picture because that portion they have specifically kept in the explanation to section 147, and you can still argue that no, you can't do this. So now there are two levels of protection. At the level of 148A-D, that is objection disposal level, officer has to dispose the objection and say that I am going to make addition on the issue on the basis of which I have furnished the information to you. And then a second layer of protection on that issue at the end in the order also there has to be addition. If at any of the one stage he is dropping the main issue, he cannot proceed further with the reopening. Now, earlier, when the concept was of reason to believe, there could be various documents, information, material which he could get post the assessment basis which there could be reason to believe. So the reason to believe was an open thing, and the material could be anything basis which he could have a reason to believe. Now, after the 2021 amendment, now the information basis which you can do the reopening is a exhaustive thing which is defined in the explanation to section 148, and the explanation has given a 5 limb of what can be the information. If your information is not falling in any of these 5 limbs, to my mind, you can argue that you cannot proceed with the reopening. Entire reopening is bad. Now, one thing we have to keep in mind here is that the information definition has gone changed from 21 till 22. In 21, instead of 5 limb, there was only 2 limb for the information. By 22 amendment, they came up with the 3 other limbs also. When they added 3 other limbs, that amendment was a prospective amendment. So for a financial for Finance Act 21, for this 1 year, you will have only 2 limb for information. For next year onwards, you will have a 3 limb. So basis of that, when the notice was issued during that period, you have to examine whether you are falling in first one, that is 21 amendment, or 22 amendment. If 21 amendment, you cannot be given a higher definition of information, or larger definition of information. Now, why this is relevant? This is very relevant for those 90,000 cases wherein the notices were issued between 1st April 2021 till 30th of June 25. When these notices were issued, it was under the impression by department that this notice is under the old law. I'm going to come to this controversy, but basically why this is important for this information. Under the old law, ultimately Supreme Court has converted this notice in Ashish Agrawal's case that this is deemed under the new law. Once this notice is deemed under the new law, it is deemed that between 1st April 21 till 30th of June 21, when this notice was issued, it was noticed under section 148A small b. Therefore, when these notices were issued, at that point of time, the information definition under section 148 was having only 2 things. Now it has a 5 thing. Again, those 2 things, in one of the things was the final audit objection, which they have enlarged in 2021 to say that any audit objection. Earlier it was a final audit objection of CNAG, now any audit objection. So in all the cases, now once the Supreme Court said that provide the information to the SSC, if your information is not falling in 1 and 2, one was if it is not in the risk parameter which is flagged in your case, or it is a final audit objection. If it was not out of any of these 2, he cannot proceed with the listing, even though the reassessment proceedings was started post Supreme Court decision, which came on 4th of May 2022. And when the reassessment proceedings under the new regime started, the Finance Act 2022 was already in the statute book, but still, when the first notice was issued, it was basis the Finance Act 2021, this argument. I'm not going into each of the limb to explain the fallout of each of the limb, because that is a topic in itself and it will take much time here. Now here, in fact, my team has done a superb job. They have analyzed and tried to find out all the decisions which is there in the public domain on the reopening issue post 4th May 2022, and also prior to that, which is not linked with the Ashish Agrawal controversy under the new regime. And they have given this, summarized the decision under the specific umbrella. Now, I will important decisions I will deal, other I will just briefly explain or briefly mention or read, and this PPT can be there with them, and appropriate stage they can read and use the decision. Now, just to start with, the first decision heading is decisions where impugned transaction was not of the SSC. Now, in this heading, I have quoted those case laws of a High Court wherein under the writ jurisdiction against the 148 AD order, that is an order disposing your objection, the assessee has said that the transaction which you are saying in the information is not at all my transaction. You have not proved that this is my transaction. I am giving you evidence that look, this is not my transaction. If that is the case, and department is not able to prove that no, this is assessee transaction, you cannot proceed with the review. Now, in the subsequent slides, I have also put one High Court, Delhi High Court, wherein they have dismissed the writ in such a situation. They say, but there the facts were slightly different. There the issue was, Delhi High Court says, if a disputed fact you want to take in the writ petition. Now, disputed fact means I was saying it was not my transaction. Department was saying no, it is your transaction. And neither assessee is able to prove with the evidence that this is not my transaction. Neither department is able to prove with the evidence that this is assessee's transaction. Then this is in the in-between era wherein the fact itself is in dispute. So then you cannot come in the writ to challenge this kind of thing. But when you are able to demonstrate with the evidence to the officer that this is not my transaction, and officer is not able to controvert that with the evidence to show that look, I have this evidence to say that this is your transaction, you cannot proceed with the review. Now the second decision is again, I find this is a very important decision of Ajiz Premji Trustee Company Private Limited. Now this decision talks of a situation wherein the issue on which the officer wants to do a reopening was already examined during the course of original assessment proceeding. On the same set of facts, same information, same documents, nothing new, officer wanted to do a reopening under the new regime. The primary argument should have been that, where is the information? Information definition is this, how you are fitting in the information. Somehow that was not the argument. Argument here was that, look, in 149, there is a two time limit. Time limit is for 3 years and 3 to 10 years. For 3 to 10 years time limit, there is an added condition that you should have in your possession, officer should have in his possession books of accounts, documents and evidence which should suggest that income-escaping assessment in the form of asset entry in books of accounts or expenditure. Now, if the same information which was there before the officer, where you have this information in your possession, new information in the form of books of accounts, other document evidence, unless you have this information, your case will fall in 3 years category. And this was reopening beyond 3 years. There could have been various other arguments which could have been tested first time here, is whether in a way when you say income-escaping assessment information suggests, which inherents build a change of opinion there. But I think this was the strongest argument there, which have convinced the court, and court have quashed the reopening proceeding basis this. All other controversy which could have been tested here, because the same information which was there before the officer, on the basis of same information you are doing the reopening. This is, if that is the case, 3 years time limit. You cannot come within the clause B of section 149(1) to get an extended time limit. Therefore, reopening quashed. This is important ruling which we have to use now whenever the officer wants to do a reopening beyond 3 years on the basis of same material which is there, he cannot do. Some kind of guidance is there from this decision of the Karnataka High Court. Now again, I feel that these three decisions which I have quoted here, Divya Capital Delhi High Court, Excel Commodities Calcutta High Court, and Dr. Matthew Cherian of Madras High Court. These three decisions is of very importance now, because they discuss what do you mean by information and how this is different than reason to believe. This is, though the Parliament has shifted the entire provision from reason to believe to information, but still in both this scheme, one thing is common, that information or reason to believe should suggest that income-escaping assessment. Unless you're crossing that bridge, you will not be able to move further. So whenever you want to make use of this, make use of challenging the validity of reopening basis, that even though you have information, but that information is not suggesting, not taking you any further, you can make use of this. Now this decision will also be applicable and will be holding its field when there is any search. Now you all are aware that after 2021 amendment, post search, the assessment will be completed under the new regime of 148. There is no 153 and 153C now. Now, under the new regime of 148, for search cases, there is some deeming fiction. The first and foremost deeming fiction is that if there is a search, it is deemed that you have information. You need not have any of those file information which is required for all other cases. Now, if that is the case, this decision will help you to say that, okay, you are deemed to have the information because there was a search, but now you have to move further. Where this information suggesting that income is skipping assessment. This is again important here because in this situation, there are 4 clauses there in explanation 2 to section 148 where they have deemed that they will have information like search, survey in assessee's case, or search in any other assessee's case, but the document or the money or anything found which belongs to or pertains to the assessee. There they have deemed that it is deemed to have information. Okay, now here deeming is of an event. If there is an event of search, there is a information. But by event per se cannot come to a conclusion that there is an income skipping assessment. If you have not found anything in the search, how will you cross that bridge of income skipping assessment? This decision will be helpful. Now again, approval mechanism is given here. I am not going to go in detail. Now, one thing important here in the last slide is the procedure given in 148A, that is disposal of objection. The Honorable Supreme Court in Ashish Agrawal's case has said that this procedure is mandatory. Okay. Basis that one High Court, the issue was the officer straight away issue 148 notice. There was no 148 proceeding, 148A proceeding. The High Court has quashed that 148, saying that you have not followed the mandatory 148A procedure and therefore your reopening is valid. Now, these are the cases wherein I have given a summary of decision where the issue was while passing or disposing the objection in 148AD, the officer has not at all considered the submission of the assessment. There could be 2 situations. Either he reproduced my submission, but he has not discussed it at all, or he has simply ignored my submission. In both the situations, in these 5 or 6 cases which I could found, the court have quashed those proceedings. Now, while quashing the proceedings, there are different kind of orders there. I could notice 4 kind of orders which I have noted in my notes. First is quashing the reassessment proceedings because 148AD, which is a mandatory thing, which was not done by following the mandatory provision of 148A, B and AC, wherein you have to consider the assessor's reply. Therefore, it is bad in law, entire thing is over, nothing more. This is the first kind of order. Second kind of order is they quash the AO's order, but this is they write a 1 para to say that AO is free to do any other proceeding which is prescribed and which is permissible under the law. I could see some kind of order wherein this is 3rd category. The AO's order is set aside, it quashed, and direction given, do it again. It will fall back to the same stage of 148AD, and you have to consider assessor's reply and do it again. This is 3rd category of order which I could see. There is 4th category of order wherein they have quashed the order and set aside to the AO to do it again with certain timelines. That within 3 weeks, assessor will file any submission, within 4 weeks, you have to listen. Now, these 4 kind of rulings are prevailing. Basis which direction you are following, you can take help of these decisions. This I think I have discussed. If the reasons on basis of which notice issued and the order basis which 148AD disposed, your order is bad in law. While discussing the Jet Airway case, I have discussed this. Again, this is discussed Nambiar case wherein mandatory provision was not followed. So following Ashish Agrawal, entire thing was quashed. Now, the second decisions are wherein the information which was required to be submitted basis the Ashish Agrawal Supreme Court decision was not provided to the assessee. Assessee filed a writ against those cases. The court have quashed the proceeding because it is mandatory to provide the information. Otherwise, how assessee is going to give their reply basis the reopening? Now, there are certain cases wherein the reopening, while giving a time to reply under 148A small b, the time limit is given only 3 days. The law says minimum 7 days, and it can go up to 30 days. But time limit was given only 3 days. The court have quashed this proceeding. Says no, nothing doing. This is not maintainable. Now, this Northwood last decision. Now, this is again very important. In the earlier law, old law, there could be various stage at which you can go in the writ court. At the 148 notice itself, at the stage of disposal of objection, at the stage of final reassessment order when it is passed. Now, here in this case, assessee wanted to challenge the reopening at 148B stage itself. The court says no, you cannot come. This is very premature stage. You cannot come at 148A/B stage, and therefore the reopening was quashed. To my mind, by and large, decisions are that after 148A/D order and 148 notice, if you are aggrieved and any of the provision not followed, then only you can come to the requisition, not before that. Now here, these are the cases wherein the courts have refused to interfere in the writ court. Now, again, the facts were very weak here. Assessee could not demonstrate with the evidence to say why and on what basis he have any case. Now, if you see the middle one, the second decision of Madras High Court, assessee challenge in writ basis that in the information vis-a-vis the notice, there is a mismatch in the figure. At one place, it is mentioned at 1,699.21 lakhs, where in this one place it is mentioned 1,699.21 lakhs. This is very premature stage. You can verify, you can very well give submission to the officer and he will consider that. So in all these three cases, the writ court have decided that they will not entertain because assessee was not able to make any prima facie. Now, again, in the old versus new regime, there is a difference in the mechanism of taking approval, which I have listed here. I don't want to go into detail. One important amendment by Finance Act 2023, which is departed from the earlier and new provision, is that earlier there was no time limit given for filing the return of income. No time limit given for filing the return of income under the old provision, and return could have been filed at any time. Even in the new provision, there was no time limit given to file a return of income pursuant to 148 notice. Now this says you have to file it within the 3 months. If you don't file, it will be treated as return filed beyond the due date of section 139, and all the consequences of belated return will come into picture. This is some important difference, and this will apply to any return which is to be filed in pursuance of 148 notice, which is issued after 2023. Again, there could be various controversies here, whether your 148A notice has to be after this date or 148 notice after disposal of 148AD notice after this date. I am not going to go in detail about that controversy, but this is the facts of each case, assessee can take benefit of that. Now, in 5 minutes, I'm going to brush the this thing because I have to for 20-25 minutes I have to discuss the controversy of Ashish Agrawal and AY 1670. See, these decisions of Sumanjit Agrawal is very relevant decision. How you have to issue a notice. They have discussed a various scenario, digital, manual, postal, before 21, after 21. I'm not going to go in detail, but one point here they have mentioned that even if your 148 notice is not digitally signed, not manually signed, it is valid if the jurisdiction of the officer, this is point B, jurisdiction of the officer name, everything is mentioned, which is in slight contrast with the Bombay High Court decision, which I have listed here in middle second decision, which says no, your 148 notice has to be either digitally or manually signed. In the absence of that, it is invalid. I am giving this presentation. Everyone can read this point. I'm skipping this, not taking in detail. Again, this point I'm skipping here. The service of notice on the incorrect address or incorrect email ID. They have discussed that what is the correct address and what is the correct email ID. Whether your primary email ID, secondary email ID, this all controversy I have discussed here. I'm not going in detail. Now, period of limitation and the old and new comparison is given. I am not discussing this because this point I am going to discuss along with Ashish Agrawal in subsequent paragraphs. How to compute 50 lakh rupees, factual thing. In notice, you might be exceeding 50 lakh. If assessee is satisfying that out of 50 lakhs, some transaction not pertain to the assessee and it below 50 lakhs, that benefit has to be given at the time of 148D order. And if it is beyond the 3 years, it will be invalid. Now here, one important order of Bombay High Court, which I have listed here. This I have listed specifically. Earlier in the old regime, there was a controversy if approval is to be sanctioned by some specific authority, German remedies, which I have already listed in my earlier slides. And instead of giving approval that a higher authority has given approval, the court has said that still the reopening will be bad in law. Now, in this case, the approval was given by the junior officer beyond 3 years, because after beyond 3 years, you have to get approval of minimum chief commissioner or principal chief commissioner. Here it was of the principal commissioner approval for beyond 3 years. Court says nothing doing, order is valid. One important order, in fact, I would suggest everyone to read the order of Vikas Gupta here. Very relevant order. They have discussed the issue of time of taking approval. This will be helpful to all other cases. Here the issue was, I have issued 148 notice, A notice, and the time mentioned in the 148A notice is 31st of March 21 at 7:25 p.m. After 30 minutes, I have taken the approval of principal commissioner, which is given to me. Court says nothing doing. Approval has to be prior to issue of notice. Even 30 minutes, 25 minutes, 24 minutes, time is not this thing. When you issued notice, you did not have any valid approval, your reopening is quashed. This was Vikas Gupta's case, was a bunch of assessee's case. One assessee's case, the time was on the same time. The notice was issued and 151 approval was taken. I could not understand why they have not seen the seconds, because in the notice now you can get the second, hours, minutes, seconds. If second wise, you could have proved that your 151 is prior or post, or assessee has knowingly, because second was might be prior or post, they have not taken the argument. The courts in that only one case has said that no, because it is on the same time, the same logic will not be applied. There they have dismissed the writ. For all other cases, they have allowed the writ that your 148 is prior to 151 approval. This next writ decision is again relevant. This is relevant only vis-a-vis AY 1516. I will slightly discuss because this controversy is linked to my main controversy, which I am going to discuss. Issue is AY 1516, 4 years completes on 31st of March 2020. 6 years completes 31st of March 2022. Under the old act, if you want to issue a notice under 148, within 4 years, you have to take approval of lower officers. Beyond 4 years, you have to take approval of higher officers. Department, while issuing a notice to these assessment years in 2021, assume that though notice is issued after 4 years, but because of the TOLA extension, this notice will be count as if it is issued within 4 years. They have taken the approval of the lower officers. The court says nothing doing. You had time till 2022 to issue the notice, till 6 years. You have issued notice in 2021. Just to take the benefit of TOLA, you cannot say that TOLA benefit can be even granted for taking the approval under 151, and this has to be treated with issued within 4 years, and the lower officers approval can be taken. Court says no, they have quashed the reassessment proceedings. To my mind, this controversy for earlier assessment years will only be applicable for AY 1516, and wherever the 1516 the reopening is done, this argument can be taken. I have taken in my case. Now this is again not relevant thing, which is general thing available to everyone. Now this again only 1 minute I will take here. Alternate remedy. Now the Red Chilli International sales, the Supreme Court on 3rd January 2023 has set aside the High Court order, where High Court said that following the earlier Supreme Court case in case of Chebil, the Leh High Court has said that this is a premature state. You cannot come to High Court against 148A order, and therefore go and your exercise your alternate remedies. Against that order, as a challenge Supreme Court, Supreme Court has set aside the order and says no, you can challenge because there are various facets which you have to see. This order is of 3rd January 2023. There is one order of Supreme Court which is much prior, 2nd September 2022. They have dismissed the assessee's claim here, and this is you have alternate remedy. I don't know on what basis they have dismissed, but we can take the benefit of red chilli Supreme Court decision to say that 148A(d) order can be challenged if it is without jurisdiction, if it is not following any safeguard given in this section in the red jurisdiction. Now, this is the timelines which I have given here, which will be useful for discussing the last part of my session. But I will come when I will discuss the particular point. Now, briefly, in 2-3 minutes, what was the Ashish Agrawal? The controversy before the Ashish Agrawal was the 90,000 notices were issued by department during 1st April 2021 till 30th of June 2021, under the impression that these notices which they are issuing is under the old unamended law, without understanding or realizing the fact that from 1st April 21, the new law was already kicked in and there was no saving clause for the old law. Even though you want to issue a notice under the old law basis the TOLA extension, because in TOLA, the extension was given for all the notices which you could have issued from 20th of March 2020 till 30th of April 2021. But for reopening, it is 31st of March 2021. You can issue such notices till 31st of June 2020. This would have been otherwise possible if the new act was applicable from either from the 1st July 2021 or from the next year. But new 147 provision was already applicable from 1st April 2021. Therefore, for these 3 months, when there was a new act or new provision of 147 already applicable, whether the old notices under the old section could be said to be valid. Various high courts have decided this issue in favor of the SSC. This I have listed here. Only one high court, Chhattisgarh High Court, has decided the issue against the SSC. Out of 90,000 such notices, the subject matter of dispute before the writ jurisdiction, as noted by Supreme Court, was only 9,000 cases. In those 9,000 cases, ultimately the matter when came before the Supreme Court has said that no doubt the High Court was right. This 1 to 8 serial number High Court was right in saying that the notices are not valid. But this is, I have to strike some balance between the old and new and SSC and department, and therefore I am by virtue of Article 142 of Constitution, I am giving an order wherein these notices first of all will be deemed under 148A, and second, this order of Supreme Court will be applicable to all the cases pan India which is either pending before the High Court for disposal, or which is pending before the High Court, which was already High Court has passed the order, but department is yet to file a SLP before the Supreme Court. This will be applicable to everyone. The High Court was silent. Supreme Court was silent as far as balance 81,000 cases wherein SSC has not decided any recourse and they have participated in the original system. Now, this was the position. Basis this, I have summarized the Supreme Court decision here. I am not discussing. Basis this, on 4th May, this order came. On 6th May, there was one clarification sought by Income Tax Gazetted Officers Association, which came in public domain. Otherwise, this should not have come in public domain because this was the internal affair, but this came in public domain, wherein they have raised various questions to the CBDT. Kindly answer this. Again, I am not going to deal because this is going to take much time. Immediately after 5 days, the same Gazetted Officers Association has came out with the answer without waiting for CBDT to give answer. And this is very important to note here. Almost all the answers which is now agitated before the Supreme Court or High Court, which a department is stretching and say that it is in favor of revenue, or SSC is saying it is favor of SSC. All those answers, whether 13, 14, 14, 15 will fall within 6 years, whether 16, 17 and 17, 18 will fall within 3 years. They have decided, or they have rather given in favor of this. They said that yes, this is the interpretation which is coming. On the same day, on 11th May, CBDT has issued an instruction under section 119, wherein they have decided these two important issues which I am going to discuss right now. The first issue is whether AY 13, 14 and 14, 15. Now I am going back to the chart. wherein I have given the timelines. AY 13, 14 and 14, 15, which is serial second and third row. The time limit for 6 years, which was getting over on 31st of March 20 and 31st of March 21, which was under the old regime, and from 1st April 21 new regime came. Whether these two cases can be reopened under the new regime, which is the Supreme Court order, because the new section of 149, which was substituted by Finance Act 29, has provided one safeguard for the past cases. That safeguard is you can issue a new 148 notice under the new section only and only if on the date when you are issuing a notice under section new section for old cases, that is cases prior to assessment year 22-23, on the date of issue of notice under new section, you could have issued a notice under old section and as per the timelines of section 149 1B. That timeline is 6 years. So if you see 13, 14 and 14, 15, 6 years is already getting expired on March 20 and 21. On these 2 days, new section were not in the picture. Therefore, the SSC's argument is that for these 2 years, 6 years is already over. Now, the proviso which gives a safeguard to me that will be applicable and you cannot issue a notice under new section. Department's argument, basis which the CBDT has issued the circular. Look, you are only looking at the timelines given in 149 1B. What about TOLA? TOLA has extended the timeline to pass the order till 30th of June 2021 for these 2 years. So the 6 years as extended by TOLA is till 30th of June 21. And I am issuing notice between 1st April 21 to 30th of June 21. I am within my rights to issue a notice. This issue was kept open by Honorable Supreme Court when it came in case of Ashish Agrawal and said that this can be taken up by the SSC while adjudicating the matter either in the assessment or in the writ jurisdiction against that assessment. Now the second controversy is for AY 16, 17 and 17. Now what is the controversy for AY 16, 17 and 17, 18? If you see 16, 17, 3 years is getting expired on 31st of March 2020. And 3 years for 17, 18 is 31st of March 21. Now, for earlier years, there are two kinds of safeguard. First, you cannot go beyond 6 years as per the first provision. Second, as per the main section, either you can go up to 3 years or up to 6 years. 6 years because of the provision. But if you want to go beyond 3 to 6 years, it should exceed 50 lakh rupees in the form of asset and you should have some documents. Now, whether AY 16, 17 and 17, 18 is within 3 years or beyond 3 years. Assess's argument is that basis same logic, 31st of March 20, 31st of March 21, this is the date which is prior to 1st April 21. Time limit of 3 years already over. This is within 3 years, beyond 3 years. You cannot reopen this 16, 17, 17, 18 unless you satisfy 50 lakh escapement in the form of these 3 things, and you should have some documents in your possession or evidence in your possession. Department's argument is same here. Department's argument is that you are only looking at the main section. You are not looking at the TOLA. TOLA has extended time limit till 30th of June 2021. And if that is taken into account, even 16, 17, 17, 18 can be reopened. And even if the case is of less than 50 lakh rupees. These two positions, the Honorable rather CBDT in their notification dated 11th May 2022, that is instruction number 122, has taken the position in favor of us. Favor of department. Ultimately, matter came up before the High Court. The first order of Delhi High Court, Salil Gulati, against the SSC. They decided that while computing the time of 6 years for going backward, as given in the proviso to section 140, new section 149, TOLA time limit also have to be taken into account. This was a 13-14 case. Delhi High Court decided against this. Immediately after that, matter again came up before the Delhi High Court. AY 13-14 case, Delhi High Court decided against this. Matter came up before the Allahabad High Court in the case of Rajiv Bansal. Bunch of cases taken up together. Detailed discussion. The Allahabad High Court has decided the issue in the favor of SSC, wherein they have taken a view that the time limit given under the 149 1B, wherein you cannot go beyond 6 years as per the proviso, that is only artificial time limit to see whether you are falling in 6 years or not. That is not a time limit to compute the assessment notice time limit. The distinction made by the High Court is that if you want to actually issue a notice under the old provision under 148 between 20th of March 20 and until 31st of March 21, you could have taken the TOLA benefit. But here, in computing the artificial time limit to what extent you can go back, you have to strictly see the time limit given in 149(1)(b). Now here the time limit is not to complete the assessment, but to see to what extent you can go. Here TOLA benefit you cannot take. Various other reasons given by the High Court. High Court has also said that the instruction by the CBDT, those two paragraphs for 13-14 and 14-15, 17-18 and 16-17 is ultra vires, not correct. Similar matter came in bunch of cases before the Gujarat High Court. Again, the Gujarat High Court in a detailed order has taken the same view as taken by the Allahabad High Court. But interestingly, if you see the last thing here against the Allahabad High Court, department has filed SLP before the Supreme Court, and Supreme Court has issued a notice and granted stay on the operation of the decision. Now this order came just last week, wherein Supreme Court has granted the stay on this order, operation of the Allahabad High Court decision. Because the Allahabad High Court here has said this CBDT instruction is ultra vires or not in intent with the Supreme Court, not in line with the legislative intent and everything. Now, because the operation of this order is stayed, you cannot take benefit of it. Interestingly, I missed to highlight this point. Against the Salil Agrawal, which was the against order of Delhi High Court, SSC has filed this SLP against the Supreme Court. And Supreme Court on 11th April 2023 has dismissed, saying what is the Salil Agrawal is correct. They said this does not require our consideration. Salil Agrawal is the correct, and they have dismissed. Now the same judges have given the stay on the operation of Rajiv Bansal order in the SLP. So we can understand where the thought process of Supreme Court is going and what could be the fate of Rajiv Bansal when it will come for the actual hearing before the Supreme Court. Meanwhile, I was discussing about the Kinara Industries case before the Gujarat High Court. Again, the same view taken by the Gujarat High Court. There was a two judge before the High Court. One judge has passed a detailed order wherein they have decided to quash the force proceedings in line with the Allahabad High Court. Though this order is on the one is on 22nd Feb, second is on the 7th Feb, but they have not considered each other because hearing was happened much prior and the order came one few days here and there. In this Kinara Industries case, there was two judges. One judge passed the detailed order of 145 page to allow all the issues in favor of the SSC, which we have discussed about 13, 14, 14, 15. The another judge has passed another order wherein the judge has said that I agree with the first judge and whatever stated by the first judge is correct. So the first judge order was approved by the second judge, but the second judge has given some more comments, which was not approved by the first judge because first judge has not had the occasion to see the order of the second judge. What was the extra observation? One of the such observation was that the finding of Supreme Court in Ashish Agrawal, wherein only the 9,000 writ either were before the High Court or pending High Court or pending for filing SLP before Supreme Court or before the Supreme Court, was the subject matter of dispute before the Supreme Court. So whether the Supreme Court order is applicable to only those 9,000 cases or it is applicable to entire 90,000 cases, because somewhere the Supreme Court has used the word pan India. The single judge has stated that the Supreme Court order will be on the entire 90,000 cases, which to my mind is the only view of the single judge. It is not view of the division bench. So we need to see how this view can be taken by the department or SSC while adjudicating and arguing those 81,000 cases which is there in the normal appeal. Now with this, I think I have discussed the issues which was pertaining to Ashish Agrawal and the fallout of the Ashish Agrawal for AY 16-17 and prior years. I think that is all from my side. Loyaji, if you want to comment anything on these provisions, please chip in.
Thank you, Nikhil. I think all the participants who are participating in this session, they will agree with me that in a short span and on a controversial topic, Nikhil has done a justice by discussing every important aspect in short and sweet manner. And otherwise, I find from seeing his preparation of the PPT, there were lots of things which he had included in his PPT, but due to constraint of time, he had chosen to ignore certain provisions, certain portions of his PPT, which I am sure that the participants will take trouble and go through it, and they will find them very useful. I think there is one question answer I am finding on the screen. Can we have a look at that? Nikhil, I'm just reading it out. It said, could you please clarify if section 194 TDS provisions except section 194Q are applicable if payments are made by non-residents to residents? I don't know whether this is relevant to our topic, but
Sir, it is actually, it is not relevant to what we have discussed, but just to answer briefly on this issue was already decided by Honorable Mumbai ITT in case of Star India, and they said that it will not be applicable, but the matter is already sub judice and before the Bombay High Court. Meanwhile, in 195, just to subdue the rationale of Star India, they have inserted that even a non-resident to non-resident payment will come in 195, but they have not made such amendment in other 194 provisions. But we need to see how this Bombay High Court adjudicates this matter, and then we can have benefit of this.
okay. So now there is one more question now. It says, can a different interpretation in view of MLI 7.1, a notice can be issued under section 148A?
Now, the answer to this question is, I will reply slightly different. First of all, now the officer has to cross a bridge of whether there is any information. Now, if you say the MLI was already there when their original assessment was there, now he do not have any other information. If he does not have any other information, how will he go and say that I am doing the reopening? First and foremost condition is to provide those information to you. What kind of information he will provide? Now, on the legal interpretation, on a reading of, forget about MLI, on a reading of any specific provision, if he has a different view, can he do that in under new 148 regime? To my mind, answer is no. Now, that kind of thing, either he has to take a help of 263 or any other thing, that is a separate issue. But for not new 148 provisions, which is somewhere different and old, wherein I would say this is some kind of mechanical thing, wherein step by step, first you have to satisfy the information is exhaustive manner, they have listed down, they will not be able to do it. This is my humble opinion.
I think that's very correct. So with this, friends, if there are more questions, we have some time, we can take them. So you can either come out on screen or audio or maybe in the chat box. It seems that there are no further questions. So I think then, I think there is one, yes. It says in this case, does not a favorable approach under the treaty become irrelevant and AO recourses to domestic law? I read it again. It says in this case, doesn't a favorable approach under the treaty become irrelevant and the EU recourses to domestic law?
The question is not clear to me here. What is the thing which Piyush want to ask?
Piyush, can you elaborate it? What is your question?
Prabhakar, can you elevate him to panel, Piyush, so that he can ask question? One minute, let me check. There's one more question.
Yeah, it says Supreme Court has dismissed Assessi's SSLP against Delhi High Court, ruling in touchstone. What can we expect further from Supreme Court? I think Nikhil has already given you a hint that by dismissing SLP against Delhi High Court and staying the SLP, the operation of the order of Allahabad High Court, it seems the Supreme Court is going in that same direction in which department has issued the circular. But Nikhil, you can say if you have any other view.
No, sir. In fact, the important point here was we cannot expect anything from the Supreme Court here. That's fine. The way the Ashish Agrawal was written by the Supreme Court. Now, in some other cases, when the matter was sub judice before the High Court and when the issue was argued before the High Court, to say that it is time barred or something like that, this is when Supreme Court can give a fresh life to those many cases. Now we have some 100 or 200 cases. We also will give some fresh life. And now High Court has given an artificial time, which is beyond the time given under the Act to pass the order or something like that. So the damage has already started from the Ashish Agrawal, and now it is further being added after the Salil Gulati has been approved by the Supreme Court. I agree with you that what further we can expect from Supreme Court, but nevertheless, this is the very new area of controversy. We need to find new reasons and ways to contest the validity. And to my mind, the basic thing is information. If we are strong and contest on the information, I think we will be able to answer many things. In fact, after the Supreme Court order of Ashish Agrawal, in all the cases, I could see that while giving the information, they have just tick box that this information is basis the decision of Supreme Court in Ashish Agrawal. They had no other information in their position. And that is the basic point on which I will go. Supreme Court says you give me the information, and you are saying the information is nothing but the decision of Supreme Court. So we need to build mainly on that. Otherwise, I agree, nothing more can be we can take from the Supreme Court.
Yeah, I agree, Nikhil. In fact, it reminds me the use of Article 142 by Supreme Court. I mean, we are expecting that a similar thing can happen, perhaps on the controversial issue raised in Roka bathrooms, that the Madras High Court decision, because it is again affecting lots of assessments which will get time barred if the ratio of Madras High Court is Roka applied. And in that case, perhaps going by the same that in order to protect the interest of revenue, Supreme Court may come out with something which we don't know. And in fact, I would not like to make any guess like that. But the doubt or the fear is there. Nevertheless, the Piyush has given some clarification. It says, let's say that domestic law has a higher rate of taxation, and subsequent to the MLI coming into operation on 1/4/20, the EU can take a different view. So will that be just considered a change of opinion? This is what I want to ask.
Very debatable thing.
I can also comment to the audio.
Yeah, yes.
Okay. Okay. So my question is this, so MLI came into operation on the 1st of April 2020. Okay. Now, what happens is, so 1st of April 2020 is, open to interpretation and notices by the AO. However, what I want to ask is, let's say, can the MLI application be made retrospectively? It is anti-abuse at the end of the day, number one. Number two, what happens is, let's say, supposing there was a transaction concluded in, let's say, 2018, okay? And in view of the MLI being in operation, the AO decides that it is an abusive transaction, and that
Yeah, perhaps the quality of audio is
If
affected.
you pick up the thread, you can reply, Nikhil.
No, Mayur bhai, in fact, what thread I could get from the Piyush, what he has written and what initially he was trying to say, there are two, three things. First of all, he wanted to understand whether the applicability of MLI can be retrospective for the transition, which is already this thing. This is old controversy, which is already there for Mauritius and everything.
Yes,
Wherein some kind of promissory
Yeah.
stopper is there. And the same thing is also applicable when GAR came into picture. We all wanted to understand whether it is applicable for concluded transition or transition which is happening there. So this is not a new controversy, which is again, there is no one line answer. Yes, you can do it, or no, you cannot do it. This will depend on the facts of the case,
Yeah.
how you have planned the transaction, what was the actual transaction, whether it was from day one started with the intent of avoiding tax, or it was some legitimate business transaction, and then subsequently you came to know that there is some kind of tax advantage, and you also want to avail that advantage. So that is a different controversy,
Mhm.
and it will depend on so many facts on this. Now, the query which I think you wanted to ask here is that at the time of original assessment proceedings, when the officer has passed the order, he had no benefit of MLI. Now,
Yes, yes.
and subsequently, he had benefit of MLI. Now, can he take a
Yes,
basis
yes.
of this MLI to say that can he do the reopening? Now, again, because this is a very new thing, what I could understand or gather from my past experience, earlier under the old regime, we had a cases that basis a retrospective amendment in the act, officer wanted to do the reopening. There, the court have taken a view that only within 4 years you can do it. Beyond 4 years, you cannot do it because there is an added layer of protection there of failure to disclose true facts truly and fully. Now, if we see this, first of all, this is not retrospective in nature. If we come to that conclusion, then can we say that if it is not applicable to those years, and you can reply that point in 144A(b) order, you can very well argue that this is not an information basis which you can do this thing. Now, if someone come to a conclusion that no, this is something clarificatory, and this is some court ruling says no, this will apply to in a past concluded transaction, then the point will be whether can he go up to 3 years or 3 to 10 years.
Yes.
So my mind here, because 3 to 10 years, there is an added protection of he should have a books of accounts, documents, or evidence. Now, whether this MLI can be constituted as evidence or not, that will be the question mark. If answer is it is evidence, you can get extended period. If not, you will not get the extended period. Now, the second question which we have to answer, whether only having this MLI is information. If yes, under which of the 5 limb he will fall. That again, to my mind, I am not able to understand where he will fall. Unless basis that MLI department goes and change their risk management strategy and it gets pop up in SS's case. If that is the thing, then it might come up as the information. If not, department has to cross that bridge also.
The department has to cross that bridge. Okay, yeah, I'll agree with you on that one. Thank you so much. Thank you so much, Nikhil. Thank you so much.
Thank you.
So, Nikhil, we have another question. It says if resident takes FTS rate as per DTA for withholding, does NRR non-resident need to file ROI in India under 115A? I think that answer is very obvious. You already discussed it.
Yes.
So for applying treaty rate, you have to file TRC and return. That is there. Then next question is, since the department is willing to close the assessment by May end, is it not in best interest of assessee to close assessment on ASAP basis?
Not clear to me. Senior ratio Vedanta may be overdone. The first question is not clear to me. 7:50 p.m. which has been written by ATJA. Second question, to my mind, Vedanta ratio may not be overturned because the reasoning and logic given by Madras High Court is very strong. And if you read the section 92, wherein the time limit to pass the TP order is defined, they uses a 2 word, before and after. So before and this thing, these 2 words came, meaning of that comes that the 60 days has to be counted after excluding the last date. And that word is very peculiar for that section. Unless they amend the section, they will not be able to overturn the Vedanta. Even if they amend the section, to my mind, they will not be will not be able to amend it from a retrospective effect. Even if they will be able to do it, they will be able to do it from the
No,
prospective.
no,
This is-
Nikhil, firstly, we have to clarify this. This is not Vedanta. I was
sorry,
talking
sir.
about Roka.
Sorry.
Vedanta
I
though is already overruled
No,
by.
the ruling
division
over
bench.
referred was Pfizer ruling by Karnataka.
sorry.
I am
Sorry.
actually
My bad. My
referring the
bad.
ruling of Vedanta by Justice Suman, wherein she has said that the provisions of Section 144C will apply prospectively, even though the statute says that all the assessment orders should be passed post for 1st October 2009, I guess, should be in compliance with 144C.
So,
was on that
sorry. I carried away with the because with the Roka, everyone now wants to understand the Pfizer. So I got carried away. See,
Okay.
Vedanta again. This is not so simple to answer. When 144C came into picture from Finance Number 2 Act 2009, it started from, again, this is not topic of discussion, but slightly I will this thing. It said that any order passed after 1st October 2009. Now, having said that, in this section itself, there was no need for them to say that this section is applicable from assessment year this and this, which is even 19 or 10, 11. They clarified this subsequently in 13 or 14. The Vedanta has taken a help from the circular of the department to say that this circular is in the benefit of the SSC. SSC is trying to take an argument that this provision is applicable on this date. First, you yourself has clarified this, and therefore it is. Now, this matter is in fact not in the Supreme Court, it is before the division bench of the Madras High Court, wherein this is sub judice and pending. Meanwhile, all the tribunal, initially, wherever they have followed the Vedanta ruling, they have now started not following it, saying that Vedanta is a single member bench decision, whereas there is some division member bench decision which have taken a view that 144C
By Zuari, sir.
Juari, yeah.
Yes, Zuari and other cases also. Zuari is of the Karnataka, but various other cases they have taken a view, and therefore Mumbai and other tribunals has taken a view that they will not follow the Vedanta. Now, in initial cases also where the Vedanta was followed and allowed, some MA is filed, that is already pending. Some they might get recalled, but this is not the matter as such which is pending in Supreme Court. But we need to see how this gets this thing. Now, this is also interesting to know. Now, in one of the cases wherein Mr. Lohia was arguing the matter before the tribunal, he wanted to take the help of Roka, and department suddenly said, no, if you want to say this thing, I will say that apply Vedanta. Now, somehow department wanted to apply Vedanta to say that for 8, 10, 9, 10, 144C provision is not applicable. Therefore, you will not be able to take advantage of Roka there. So again, the pick and choose is going on. Everyone is trying to take the help of whatever ratios or decisions available in their interest, so that the order is somehow getting saved either from Roka or from Vedanta or from Pfizer. So that is all going on. Now this
We'll take the last question. It says, is the risk-based strategy means inside portal? Department is still reopening matters despite Allahabad High Court ruling, wherein cost of rupees 50 lakh was imposed.
Now, this issue, what is the risk-based strategy and what is the inside portal? Now, there is one circular which I could lay hand on, is dated 10th November 2021. This 10th December 2021 of the, in fact, it is not a circular, it is an instruction given by CBDT to their officers. Now, this instruction I will share along with my presentation. It talks of instruction under section 119 regarding uploading of information on VRU, that is their verification report upload. Functionality of inside portal for implementation of risk management strategy for issue of notice under section 148. Here they have listed down what kind of information each officer has to upload on this verification report upload, so that can be used for formulating the risk management strategy, which will be again then populated in each assessor's case. Now I will read some of the information which is mentioned here. Information from any other government agency, law enforcement agencies. Information arising out of internal audit objection, which requires action under 148. Information received from any income tax authorities, including the assessing officer himself or herself. Information arising out of search or surveys. Information arising out of foreign trade and TR references, like various other things. So one kind of hint which I could get is wherever they think that this could not fall in any of these 4 bracket of information, they will put as this kind of instruction to the officer. Basis this instruction, they will upload this on the verification report upload portal. From there, this will be picked up as a risk management strategy and populated in all other cases. This is again at very initial stage. After this 2021, I could not get any such instruction in the public domain wherein they have instructed their officer to do something like this.
So I think we had a very healthy discussion, and whatever in the possible time we could do it. And in fact, now I would like to conclude by one chupai from Ramayana, which says Hari Anant, Hari Katha Ananta, Kai Sunai Bhavidhi Sab Santa. So ये तो हरि अनंत हरि कथा अनंता की तरह है. डिपार्टमेंट का रुख, एसएससी का रुख, इनकम टैक्स की इंटरप्रिटेशन सब चलती रहेंगी. And in times to come, we will come to know more interesting aspects. And with this, I would like to conclude the session. And thanks a lot to Nikhil for giving us a very apt solution to various problems which we have faced so far and which we are likely to face. And with this, I will hand over to Mayur Bhai. Mayur Bhai.
Thank you, sir. Friends, you will all agree that we had a very captivating meeting today, where Nikhil took us through the intricate provisions with his mastery analysis of the various case laws, the amendments, the background, and the impact it's going to have, with a very apt comments and inputs from our chairman, MP Lohia. So on behalf of the Western Region chapter of the IFA India branch, I thank both of them, Nikhil Tiwari and MP Lohia sir, and request you to carry this vote of thanks with a loud applause. And thank you, sir. Thank you, Nikhil, for coming and gracing this meeting. Thank you very much.
Thank you,
Thank you.
Mayur Bhai. Thank you, everyone. Thank you.